U.S. consumer spending surging in April. It's the strongest pace, actually, in 3 years, according to Bank of America data that shows household card spending rose by 4.8% from last year. Joining us right now is Everett Krisberg. She is the head of the Bank of America Institute. And Liz, thanks for coming in today. I want to talk about these numbers, but let's talk about why we focus on these numbers. You all have almost 70 million accounts, consumer and small businesses, that you're watching on a daily basis. So you get constant updates about what's happening in real time.
Correct.
This is the strongest April you've seen in 3 years?
In 3 years, 4.8%.
Yeah.
But, you know, one of the things that I think people are going to think is it's only strong because of gas prices, right?
Yeah.
And if you strip out gas, you still saw spending grow by 4%, which was an acceleration over the 3.6% ex-gas in March and in February. So it wasn't just strength because higher prices at the pump. That being said, the resilience is uneven. It's being driven by higher income consumers, and we are starting to see preliminary signs of the lower and the middle income consumer getting squeezed.
What kind of signs?
So the easiest way, I think, to think about it is if you look at where spending is. So higher income consumers, their spending growth was around 5%. Lower income consumers, they went up 3.1. Okay. Now compare that to how much money they have coming in, because we look at the wage data too. Higher income consumers, remember, they're spending 5. Their wages were up 6%. That's the highest growth we've seen in years. But their wages are outpacing their spending. Now let's look at the lower income consumer. Their wages increased, but they went from 1 to 1.5%. So that's less than half of where their spending is. So they are getting squeezed because their wages aren't keeping up with what's going on.
Are they increasing their spending by taking it out of savings? Are they increasing their debt spending with a credit card?
So they're doing a couple of things. One, from a spending perspective, they're pulling back on discretionary. So we're not seeing that overall, but within the lower income consumer, they are pulling back on their discretionary spending. And they do have buffers to help kind of bridge this gap right now, and they've got them in a couple of different places. They've got deposits, they've got savings, right? They've got tax refunds, which we can really drill into, and then they also have, you know, potentially credit. And when we look at credit overall in the aggregate, credit card utilization, it's kind of at the same level it's been since the kind of 2010s, since before the pandemic. But for the lower income consumer and for the consumer that's not paying off their bill every month, right, the revolver, you are seeing their credit utilization tick up. So that's one way that they're funding it. It's not at dangerous levels, but it is higher than the aggregate. The other thing to think about in terms of buffers is tax refunds. We're, you know, just finished up April, so most people have gotten their tax refunds. What we have seen so far is only about 20% of the tax refunds went to spending. 50%, just about 50%, went to increased savings. So that is something that can help support this. And then about a quarter, a little over a quarter, was used to pay down debt. So we haven't, that buffer, that catalyst from tax refunds isn't totally gone, but it is something that is not going to infinite.
It says 7-day data suggests softer spending. How much did it fall off a cliff at the end of the month?
So that's a great question. And you think about
really?
It is a great question. Give you credit for that one. If you think about the aggregate, how the aggregate was great, but breaking it down is different. If you think about the daily spending, that tells a slightly different story than the full month. And what we saw was we did see spending come down the last week of the month. But I think that is not, it's too early to really be concerned about it because that's not atypical. It tends to go down at the end of every month, the last week. It went down
because you know, as John Hope Bryant always says, I ran out of month before I ran out of month. I ran out of money before I ran out of month. I think is
yes. But again, this is very typical, and it went down a little bit more in April than it did in March, but it was the same amount that it went down in February, the same amount that it went down in January. So a little too early to say that the consumer has run out of money at the end of the month, but it's a pattern we see, but it's one we're going to continue to watch.
You said that credit card spending is not at dangerous levels. What is
utilization?
The level okay, credit card
utilization. So it's not. People have not run out of they still have credit. You know, they're not at their limit. They're not at their limit. So they still have some credit, but it's a little less than they had before.
Overall, if you just had to say, here's where we stand, the state of the consumer today.
I mean, overall, the consumer is still resilient. Overall, the labor market, we talk about jobs. Jobs are being created. Wages are going up. But it's uneven in where it's falling out. So higher income consumer continuing to do really well. lower income consumer getting stretched.